All right, so going through this here, this is EX 12-15. So you have your investment in the nursery supply shares, 56 million cash, 56 million, pretty simple. That's easy. Then here we're taking in that income, like we talked about just a little bit earlier. We have the 12 million as a part of that because we take 30% of their net income. We take that into our company, increases our investment in that, and then we also take that as investment revenue. I'll spell that out. And then finally, we have our dividend, which we would take away from our investments because we are paying that out, but it comes to us in the form of cash. So we have an increase in our cash by 3 million and a decrease in our investment there. Now, to figure out that 3 million, it is the 30% of the 8 million shares times the $1.25, which gives us 3 million. And so our total investment amount of investment in this company would be the 56 plus the 12 minus the 3, and that's what we show on our balance sheet as $65 million in that company. Remember, this is for the equity method only, and it is different for the available for sale, and we'll do that in the next problem here. Questions you guys have? So look at that? Okay. So let's take a look at the next one. So the next problem is, see, this one we will do, we have no significant influence when we acquired this company, so it's going to be a little different. It's available for sale, right? Yes, we available for sale. And so because of that, what we're going to do is we have the purchase of that. How much was that? It's EMC common shares. Investment. See. That's down a couple times. How much was that? 480. So we have 480,000. Okay. Now the next part, it tells us, well, as we look at this here, we have net income, and that's typically what we'll talk about. Remember, in the available for sale, we don't worry about net income because we don't take any of that in, right? All we worry about is then any dividends that we get as a part of that, and then you're going to do an adjusting entry to the fair value, market value of that. So this is available for sale, so there's no entry here. Let me slide this up a little bit. Room. All right, so we have cash. And then we have investment revenue. How much was the dividend? 100,000?
Yeah. Was it 100,000?
That's 100.
Because you take the 400 shares times 0.25, right?
Yes, but then
0.2
yeah, 20. I think that sounds all right.
24?
Oh.
Okay.
Should be 20. So what you should have is this here, the 20% times 100,000 shares. Is that what it is?
Yeah.
And then times 25 cents. So it should be 20,000. It trick you again on that one?
I don't know. I just wouldn't have worded it that one. Just say how many shares you bought. I know, right?
All right. So next is an adjusting entry here. So we have an adjusting entry here. Now, where does the change in fair value go to? Remember, this is available for sale, so AFS goes to OCI. Good. So OCI. So this is going to be a net unrealized gain or loss into OCI. And that's where we're going to put this here. So we have a fair value adjustment. And you guys know what the adjustment is? 25,000. Sounds good to me. And unrealized. OCI. And that goes as 25,000. All right. I'm going to get that 25,000 to 505 minus the 480. What they gave us there. So that is the first part of the problem on EX 12-14. All right, so questions on that? I'll give you a moment to get that down. Missing anything there? And then I will redo this doing the equity method. Remember what changes in the equity method then? You must have net income. Is it not running?
It's running.
Okay, good. So remember, in the equity method, which we just did on 12-15, there's going to be a net income here we have to take in, and we don't have an adjusting entry. So that's the difference, remember. So we're going to do both with both of these here.
So it's only available for sale when we do the adjusting.
That or trading securities too.
Trade securities we do
Yeah,
adjusting
yeah,
too?
exactly.
Okay.
Trading securities also.
Okay. And do you do net income for trading securities or no?
Nope.
Okay, so they're pretty similar.
Yeah, they're pretty available for sale, and trade securities are similar, other than remember where it goes. It's IS
yeah.
instead of OCI.
Okay,
Yeah,
that's the only difference though,
that's the
really?
really only
Okay.
difference on some of those things there. Yep. All right. So this stays the same here. Let me change all of this. I'll just erase all of this. So we have our net income. What was the net income that we take in there for the company? 20,000? Oh.
250,000.
How much is it, 250?
No, it's 50,000.
Okay, that sounds better. The 250, I think, was the total amount of the revenues. We have to take our portion of that, which is 250 times 20%. Okay, so, let's say that was 50,000. All right, so dividend. Remember, this is going to be cash, and then investment to AMC common shares.
20,000.
Is that
That's 20,000.
20,000? All right, because we had that already. Good. And remember, where it goes is differently. The accounts that we use cash, and then we decrease our investment accounts with that. You guys get a good handle of this? All right. And remember, there is no adjusting entry. So adjusting entry, we don't even worry about, so no adjusting entry here. We don't worry about it when we do the equity method, because we're taking into account any changes that the company had in their income and their dividends. All right, so questions? We doing okay so far? Easy stuff? All right. So you guys are getting this? So you guys are going to ace the test?
Yes.
Sure. Computers. All right, so let's take a look at the next problem, which is on page 773. You guys able to get to this one? No? Well, we'll have to do it anyways. All right. Here. All right, so let's read through the problem here real quick. So this company here, Quantum Technologies, the energy supplier, borrowed $16 million in cash to fund a geological survey. The loan was made by Nevada Bank under a non-committed short-term loan credit arrangement, 9 months, 12%, and the interest was paid at maturity. So we have the journal entry for the issuance of that. So pretty simple there in cash, it was payable. So let's do that real quick. All right. $16 million. Isn't it? I had the wrong number?
Yeah, that's right. What, I don't know. What are we doing?
13-1.
Oh, I'm on B.
I'm just coming up with random numbers, don't mind me.
Okay.
All right, so the next part of the problem says that we will prepare the appropriate adjusting entry for the notes on December 31st. So we did this on November 1st. So we have interest expense and interest payable, right? So what's our interest expense there? Want to take a stab at it? $320. Sounds good to me. Get that? He did 16 million times 12%, and multiply that by 2/12 for the 2 months. Now you got it? Something like that?
Yeah. Wait. So is it okay if you do?
If you divide it,
9/12 and then times 2 9ths?
yeah, I mean, yeah, you figured it out for each month. So,
Just
yeah,
so-
that, which is fine. You can do it that way too. It was the same way. You figured it out for each month, which is good. All right. So lastly, then we're going to do requirement 3. So we have interest expense, notes payable, or interest payable, notes payable. Let's go ahead and work through this. So this is 1, 2, this is 3. Notes payable. And cash. Interest payable. 50. What's our interest, interest expense? What's our interest expense, anybody know?
Do you do the total or? Yeah.
Yeah, 1.12 million. So basically, it's the total 16 million times this 12%, and then times 7/12 for the last 7 months. And then we added into the interest payable because we made that commitment back here when we did our statements here. We already took the interest expense right here. So we're not going to take it again, we just do it on the interest payable. And then our total for that would be 744 million. Is that what it is? All right. All right. As you guys are getting that down, I'm going to do the last one here. And our time is expiring a little bit here. So let me jump into the next one, which is 14-7. Let you guys get that down. So 14-7 says Universal Foods issued 10% bonds dated January 1st with a face value of $150 million. The bonds mature 15 years. The market rate goes similar to 12%. So the difference between 10 and 12%. Remember that? And it's paid semi-annually at the June 30th and December 31st. And we're going to use a straight line method, so it makes it easier for us to do this one. So since we're doing the straight line method, it makes it pretty easy. So remember, to figure out the interest, what we're going to do then is take the interest rate, which is what is stated, into the amount. So 10% times 150,000 Thank you. And then we'll divide that by 2 for that because we do 2 payments. So or we can just do this times 5% because of that. So either way, so 5% times 150 million, that gives us 7.5 million that we will have there. Then we look at the table for these numbers here. Remember, we're going to use the market implicit rate, which is the 12%. Since we're doing 2 payments, we'll then take that, look at 6, and since it's 15 years, we double that because we're doing 2 payments, so it'll be 30. So that's where you come up with here at 30, and then 6%. So you'll look at the for the ordinary annuity. Remember, annuity, when you look this up, means for the interest ones we'll be looking at, and then the present value we'll look at just the principal. Remember, annuity means payments in the future. I will also have this out there. I'll put this on canvas for you. So questions on how we came up with these? So this is the present value of the bond right here, which is 129 million. Remember that it was selling for the bond face value is 150 million. So that's what we have here. And then basically what you're going to do is take out the discounts there. So this is the purchase price of it. This is the bond payable, excuse me, that's what you have. This is your purchase price, what you paid out. And this is the discount that you got on it, which is 20 million there. To figure out then what our discount would be amortized over the 30 payments, we just divide it by 30. And that gives me the discount here. And then I add that to get that interest expense because it will continue to, and by the time we're done with our amortization schedule, we get to 150 million. So we move up from basically 129 million to 150 million over the 30 payments. So we're increasing that. That's all up here. I'll let you guys, if you have any questions, let me know. This will be posted on Canvas probably within the next couple hours, depending on my meetings and everything. And I will also have this tape up there too. So if you do want to review anything that I talked about or something like that, you can review it also.